1,000 points isn't what it used to be. Remember when it was 20,000? So a 1,000-point move at 20,000 was 5%. Now a 1,000-point move is 3%. We like to point out the simple mathematics of this. You do, David, of course, because you know how to do math. But a lot of people seem astonished by this. What bothers me is how we got to the 1,000 points. It's very, very narrow leadership, and it's getting narrower. And that's usually signs of market peaks, at least short term. So Apple, 3 stocks were 2/3 of the gain in the 1,000 points. 650 points was Apple, United Health, and Goldman Sachs. And again, you have to, it's not the percentage gains that matter, it's point gains, because it's a Dow's a price-weighted index. If you add in 4 other stocks, you throw in McDonald's and Visa, Microsoft, Johnson & Johnson, that's the other 350 points of the 1,000 points. There you get 7 stocks or the 1,000 points gained in the Dow. And it's even worse in the S&P 500. We're up 1.3% on the year, and the big 5, look at this, are up 3 times better than the overall S&P. So when you have that kind of concentrated leadership, the good news is you can pull indexes forward. The bad news, it gets kind of narrow. And we should have this problem. You know, we've got a neutral Fed. We've got decent jobs growth, not as fabulous as we thought, but decent job growth, trade truce, and some kind of hopes for a bottoming in the global economy. And we're worried about narrow leadership. But that's what it's down to. And the question now is, the president's going to be next week with the deal, signing the trade deal. We're going to have the Fed meeting in 2 weeks. They're going to be neutral. All this is good news, and yet it may not be enough to move the market forward because it's all sort of already assumed that this is going to happen. Now, what are we going to do? How are we going to keep moving the market up?
I was just going to say, earnings are right around the corner. I mean, is it going to be a sell on the news if we get good earnings results? Are they going to have to be really blockbuster out of the park to really move some of these names higher?
Well, we did this yesterday. What worries me is earnings typically come down, the estimates, as we go into the quarter. That's very typical. But it doesn't come down when you have a 12-13% rally in the fourth quarter in anticipation that everything's going to be better because we got rid of all of these concerns like the Fed being aggressive and trade wars. All that went away. That was supposed to improve earnings overall. We're not really seeing any real lifting of earnings expectations. So, yes, I think, Courtney, you're right. It is earnings that are going to make or break the rally in the next several weeks.
But to your point, Bob, I mean, Apple, Facebook, and Alphabet all up over 6.5% for the year right now, right. And the largest 3 amongst the 5 largest market cap companies in the country are moving the S&P. I mean, they are sort of the engine here. Those are enormous moves for, what, a week into the year?
That's right. And now we've got a situation where we're at 18.5 times forward earnings. It's important to point out that generally the S&P stays in a forward multiple. Next 4 quarters out on the S&P earnings, usually between 14 and 17 is a very typical number. When you start getting up to 18.5, that's in the higher end of the range in the last 20 years. And David, you know, and that was a terrific thing you showed this morning with the AOL Time Warner thing. That really was something. Right? Yeah. It was so great to see your pictures. I love it when we see pictures of you back then. Of anybody, all of us back then.
Thank you, Bob.
We were at 26 forward multiple at 99.
Right.
At that moment, just 26, 27. But we've never seen those kinds of multiples before. Now, we got high. We were up there a couple of years ago. We were up around 18, 19. But it's unusual to see this kind of multiple. Stocks are very, very pricey, and they have to justify at this point with prices up, earnings down. That's how you get these kinds of high multiples. We better have really good, really continually good economic growth. We better have really good job growth to justify that kind of multiple. It's hard to do that at this point. So I think like I said, we should have this problem. This is a good situation. We're in a very, very good situation right now for the markets. But I have a hard time figuring out how we're going to keep advancing it. And I think that the numbers are going to come down on earnings in the next few weeks. There's going to be some disappointments. We already saw that FedEx was a major disappointment.
You're not quite saying bubble yet. I'm not.
No, that's the problem. You get on everybody knows that we can knock on the door of high multiples and frothiness and stay there for a while, but the numbers have to keep staying up there. The economic numbers have to stay up there. We've got to get a bottoming in the global economy. The ISM, the global manufacturing numbers have to not just bottom, but kind of come up towards above 50 on all of those numbers. We've got to, I don't think it's going to be enough to say the Fed's neutral and that's going to keep moving the stock market forward. I don't think that's enough anymore. We need a little bit more than that at this point. So there's a lot sort of riding on it. Expectations are very, very high to keep things.
The Bulls would say we cleared the decks on trade disputes, and those 3 Fed cuts are going to kick in, which they do with a delay.
And here we are, right? But here's the numbers. The price, it's already in the market. That's the question right now. So again, ultimately, there's got to be a relationship between earnings and the multiple at some point. You can't stretch the multiple too far. It just pulls back historically, unless we're going into uncharted territory that we've never seen before. We saw that in 1999. We saw what happened.